Global uncertainty doesn't start with explosions, collapsing markets, or panicked headlines. It begins quietly, in the places the public never looks. The bold threat shaping this moment is simple. Money moves long before people understand why it's moving. And when it moves during global uncertainty, it rewrites not just markets, but the balance of power itself. Here's what nobody tells you. By the time fear reaches the streets, smart money has already finished repositioning. This is where the pattern begins, and here's why this matters. The movements happening right now echo the same signals that preceded 1914, 1971, 1997, and 2008, years where entire financial landscapes were transformed in a matter of weeks. Yet the real question isn't about the past. It's whether the mechanism that governed those moments is already operating beneath the surface again today. To understand how smart money behaves, you must first accept a harsh truth. Uncertainty is not chaos for the wealthy. It's information. It's a map. It's a timing signal. In 1914, as Europe marched toward war, bond markets tightened long before a single troop crossed a border. In 1971, just months before the U.S. abandoned the gold standard, foreign central banks quietly pulled gold reserves out of American vaults. In 2008, liquidity froze in obscure corners of the credit system long before the public heard the words Lehman Brothers. These were not coincidences. They were rehearsals. Every era of instability produces the same choreography. Smart capital detects stress, reallocates silently, and waits for everyone else to wake up. By then, the entire board has already changed. That's the promise markets sell. The illusion of stability. Numbers on screens, lines on charts, predictions packaged as certainty. Yet the reality is more predatory. Markets behave cyclically because humans behave cyclically, overconfident in good times, blind in transitional times, desperate in bad times. Smart money doesn't avoid uncertainty. It studies it. It asks not, is something wrong? But, where is the imbalance forming? And those imbalances appear long before the public feels them. Credit spreads widening. Foreign exchange markets twitching. Liquidity thinning in places only institutions watch. These signals are invisible to most, but they are the heartbeat of global finance. This is why the origin story of smart money isn't tied to a specific decade. It's tied to a mindset. In the late 1800s, London's banking elite watched the world through telegraph wires, responding to whispers of droughts, famines, uprisings, and government disputes before newspapers could even set type. In 1971, currency traders didn't need a press conference to sense the dollar's vulnerability. They saw it in the way foreign capital hesitated, in how gold markets tightened, in how U.S. deficits ballooned. And in 2008, hedge funds didn't need a headline to detect fragility. They saw it in mortgage-backed securities trading at discounts that didn't match official narratives. The mechanism hasn't changed, only the speed has. Smart money operates in 4 phases during global uncertainty. The first is observation. This is the phase where tension is rising, but the public is still calm. Think mid-2007. Think early 2020. Think the weeks before major geopolitical ruptures. Analysts suggest that today's world may already be hovering in a similar phase. Wars, inflation, supply chain fractures, demographic pressures, technological upheaval, these elements don't trigger panic on their own. They create the background noise smart money listens to. When that noise changes pitch, the second phase begins. Repositioning. Repositioning is subtle. It doesn't look like panic. It looks like unusual activity in commodities. It looks like sovereign wealth funds quietly increasing reserves. It looks like institutions shortening the duration of their bonds or shifting cash offshore. These moves rarely make headlines because they aren't designed for public visibility. They are designed to create distance from risk without revealing motive. At first, it might look like a miracle. Markets remain stable despite troubled conditions. But then the bill arrives. Prices change. Volatility spikes. Liquidity dries up. And the public wonders what happened. But uncertainty doesn't just affect institutions. It reshapes societies. In 1914 and 1971, ordinary families didn't understand the global shifts underway until their currencies lost value. In 1997, millions in Southeast Asia saw their savings evaporate overnight. In 2008, retirees watched pension balances fall while institutions seized assets at discounts. The danger wasn't what they saw. It was what they ignored, the silent repositioning that happened months earlier. Today, the same mechanism may be forming again. Some economists argue that current geopolitical fragmentation echoes the conditions of the early 20th century. Others suggest that increasing debt loads and monetary shifts resemble the late 1960s. One scenario indicates that emerging technologies, AI, automation, cyber warfare, are creating a new type of uncertainty that previous generations never had to navigate. If this pattern applies, smart money will not wait for clarity. It never has. The third phase of movement is consolidation. This is when global uncertainty becomes visible to everyone. Markets swing wildly. Governments intervene. Interest rates spike or fall sharply. Narratives shift hour by hour. During this phase, the public reacts while smart money fortifies positions established months earlier. In 2008, consolidation meant the acquisition of distressed assets. In 1971, it meant reallocating wealth toward commodities and emerging markets. In the 2020 pandemic, it meant tech dominance and the explosive rise of new asset classes. Everyone thought they were safe. They weren't. Consolidation is the most dangerous phase for households because it triggers emotional decision-making. Loss aversion, panic selling, over-leveraged positions unraveling, and governments, often too slow or too political, attempt to stabilize markets using tools designed for simpler eras. This is where the trap begins. Institutions have optionality. Individuals have obligations. Institutions can pivot instantly. Individuals cannot. That asymmetry feeds the next phase. The fourth phase is acceleration. After repositioning and consolidation, smart money begins exploiting the inefficiencies uncertainty creates. In the 1970s, acceleration took the form of explosive growth in commodities and newly deregulated markets. In the 1990s, it fueled globalization, outsourcing, and speculative bubbles. In the 2020s, analysts suggest acceleration may occur in artificial intelligence, energy transitions, biotechnologies, digital currencies, and new geopolitical alliances. Not safety. Reinvention. Yet, behind every movement, observation, repositioning, consolidation, acceleration, looms one looming question. Is smart money preparing for a world reshaped by uncertainty, or a world defined by it? Are these movements defensive or opportunistic? Are they preparing for stabilization, or are they preparing for fragmentation? That question leads directly into the next part of this documentary, because the mechanism doesn't end with capital movements. It ends with consequences. And those consequences may be the most misunderstood part of all. The mechanism of smart money doesn't end with observation, repositioning, and consolidation. It mutates. It accelerates. It redraws the financial map in ways that ordinary citizens only begin to perceive when prices distort, opportunities vanish, and governments scramble to catch up. Here's what nobody tells you. Global uncertainty doesn't just shift capital. It shifts power. And once power has moved, restoring the old world becomes nearly impossible. This is where the mechanism continues. Quietly, relentlessly, with consequences that unfold long after the headlines fade. To understand the evolution of smart money's behavior, imagine uncertainty not as a storm, but as wind. Some structures, fragile, over-leveraged, politically constrained, bend or collapse. Others, built deliberately with diversified supports, rise above it. Wealth acts the same way. During each major global rupture, capital moved into specific domains: currency, geography, asset class, and time horizon. Those four shifts created the backbone of modern finance. Today, analysts suggest we may be witnessing those same shifts again, but magnified by technology, geopolitics, and the speed of digital networks. The first domain is currency. In moments of uncertainty, smart money seeks shelter from weakening sovereign promises. In the 1970s, it moved from the dollar into gold, commodities, and eventually into the foreign exchange markets that exploded in size after global currencies were allowed to float. In the late 1990s and early 2000s, it gravitated toward the rising strength of the euro and emerging markets. In 2020, it fragmented, part into dollars, part into crypto assets, part into commodities. Now, some economists argue that the current era may feature a new form of currency migration, not just away from certain national currencies, but toward programmable money, central bank digital currencies, and decentralized financial ecosystems. Not replacing the old, restructuring it. The second domain is geography. Capital moves across borders long before people understand why. Before World War I, wealthy families quietly transferred gold to the United States and Switzerland. Before the 1997 Asian financial crisis, capital fled Thailand, Indonesia, and South Korea weeks before governments admitted vulnerability. Before the 2022 energy shock, European firms secured fuel contracts outside traditional partners. Today, one scenario indicates that smart money is rebalancing across regions, diversifying away from singular dependence on any one superpower, splitting across North America, the Gulf states, selective parts of Asia, and resource-rich regions in Africa and Latin America. Geography is no longer just a map, it's a strategy. The third domain is asset class. During tranquil periods, investors seek yield. During uncertain periods, they seek resilience. But resilience evolves. In the 1970s, it meant commodities. In the 1990s, it meant U.S. technology stocks. In 2008, it meant U.S. treasuries and distressed assets. In 2020, it meant technology platforms, AI companies, and short-duration assets. Now, analysts suggest smart money is experimenting with a hybrid model, part tangible, energy, water rights, infrastructure, part intangible, AI, automation, data monopolies, part defensive, short-duration debt, and part speculative, emerging technologies. At first, it might look like a miracle, markets staying afloat despite global fractures. But then the bill arrives in the form of new imbalances, where wealth concentration accelerates far faster than economic growth. The fourth domain is time horizon. During global stability, investors think in years. During global uncertainty, smart money shifts between extremes, hyper-short durations to manage risk, and ultra-long durations to capture structural change. This duality is powerful. It's why, during the chaos of the 2020 pandemic, some funds traded by the second while simultaneously investing billions into decade-long technological transformations. This is how wealth preserves itself, not by choosing one strategy, but by choosing many across multiple timelines. And yet, beneath all these shifts lies one of the hardest truths: someone always benefits and someone always pays. That divide widens during global instability. Institutional capital gains optionality. Households inherit rigidity. This asymmetry explains why, during the 1970s, inflation devastated the middle class while commodity traders became legends. It explains why, during the 2008 crisis, millions lost homes while private equity firms acquired properties at discounts never seen before. It explains why, during recent global shocks, governments injected trillions into markets, but ordinary citizens saw living costs rise faster than wages. Everyone thought they were safe. They weren't. Households react emotionally. Smart money reacts mechanically. Households wait for clarity. Smart money moves the moment uncertainty emerges. Households aim to preserve what they have. Smart money aims to expand during chaos. This is why wealth concentration surges after every crisis. And if analysts are right that the world is entering another cycle of prolonged uncertainty, defined by geopolitical fragmentation, monetary experimentation, energy realignment, and rapid technological disruption, then the mechanism may already be shaping the next decade. But modern uncertainty has a new twist: technology. Artificial intelligence, automated trading, predictive analytics, and real-time data streams allow institutions to move capital faster than any generation in history. A shift that once took months in 1914 or weeks in 1971 now takes seconds. Some economists argue this speed could make future crises sharper, faster, and more synchronized. One scenario indicates that capital flight during future shocks may be nearly instantaneous, amplifying volatility before governments can respond. Not slow collapse, rapid realignment. The trap hiding in all of this is surprisingly simple. Smart money operates based on anticipatory movement. The public operates based on reaction. Those two timelines have never been more out of sync. Here's the trap. By the time ordinary people understand the implications of uncertainty, whether economic, political, or technological, the major moves are already complete. Assets are already repriced. Options are already gone. Opportunities are already captured. And history shows this pattern repeating with unnerving precision. Yet this documentary isn't about doom. It's about recognition. Because while households cannot move like institutions, they can observe the same patterns. They can understand the phases: observation, repositioning, consolidation, acceleration. They can recognize the signals that historically preceded major global shifts, not to predict perfectly, but to avoid being blindsided. Here's why this matters. Uncertainty is not random. It follows structural pressures: debt loads, demographic changes, energy realignments, technological leaps, geopolitical fractures. These forces shape cycles whether people acknowledge them or not. And now, the world faces a convergence of all five at once. Analysts suggest that global debt levels resemble conditions that historically precede monetary restructuring. One scenario indicates that geopolitical alliances are shifting toward multipolar fragmentation. Another argues that technological disruption, particularly AI, may concentrate economic power faster than any previous innovation. Meanwhile, inflation, supply chain volatility, and demographic decline push governments toward interventions that may create unintended aftershocks. If this pattern applies, then the next major realignment of wealth may already be unfolding. But here's what nobody tells you. The most important movements aren't happening in stock markets or commodity prices. They're happening in trust. Trust in currencies, trust in governments, trust in institutions, trust in the narratives that built the last century. When trust erodes, money moves. When money moves, power moves. And once power moves, the world that emerges rarely resembles the world that collapsed. The final question is not where smart money is moving today, but why. Is it anticipating instability or a new order? Is it hedging against collapse or positioning for reinvention? Is it protecting wealth or preparing to reshape it? That question leads to the closing moment of this documentary, because the mechanism of smart money isn't merely financial, it's civilizational. And the consequences of the next major movement may determine the structure of global power for the next 50 years.